Good afternoon and welcome to Managerial Accounting. Today is day 3 for the fall 2022 semester. And we're going to be continuing and finishing up chapter 15 today. So you'll want to have your chapter 15 exercises available. Just a reminder that I will not be here next week. So Thursday, we will talk about what class will look like for you next week for those of you who are taking the class face-to-face on campus, so that you'll be familiar with where to find what you need to do and where I expect you to be by the end of the week. Also a reminder that Monday is Labor Day, so even though our class doesn't meet on Mondays and it doesn't affect this class, you should know that there are no JCC classes on Monday at all. So if you have Monday classes, they will not meet on Labor Day. They will still meet 15 times throughout the semester like any other class, but they won't meet Labor Day. So last class, we started our discussion of chapter 15, and we talked about how the balance sheet looks different for a manufacturing company because they have 3 separate types of inventory accounts. Those are materials, work in process, and finished goods. We talked a little bit and I showed you that flow chart, hand-drawn diagram of how costs move through the inventory accounts on the balance sheet and then onto the income statement. We also talked about the 3 component costs that make up every product: direct materials, direct labor, and overhead. We talked about how you can classify costs based on whether they're fixed or variable, whether they are product or period costs, whether they're value adding or non-value adding. And so we're going to be using those cost classifications throughout the semester in various chapters. We introduced the terms of prime costs. Those are the direct costs, direct materials and direct labor, and conversion costs, which are the direct labor and overhead combined. Those are the costs of taking the direct materials and turning them into a finished product. Does anyone have any questions about those concepts, terms that we talked about last class? Okay. So where we're going to be starting today is taking a look at and constructing for ourselves some of the financial statements and reports that a manufacturing company would use. So we're just going to be tweaking what you already know from financial accounting about what belongs on the income statement, for example. So as we said last week, this semester we really are focused on manufacturing companies, although we do somewhat regularly talk about what would this look like if you were a service company or a merchandising company. But our focus is primarily on companies that are making their own product. And because they're making what they sell, it adds just an extra layer of complexity to all of the accounting that we are already used to doing from financial accounting. So again, I already reviewed these 3 types of inventory accounts. Now, when you look at the company that you choose for your annual report project, when you look at their balance sheet, even if they're a manufacturing company, you are not likely to see 3 different inventory accounts listed there, because what you're looking at is more of a summary of their individual accounts. So you may just see one line that says inventory, but I can assure you, if they are a manufacturing company, they do keep track separately of these 3 categories that we've already discussed. So you can see here how on that top balance sheet on the slide, the top balance sheet, Musicland stores, they have just 1 inventory account, so they may be a merchandising company. Where Legend Guitars is actually making the guitars, and so they list separately the 3 different types of inventory accounts and then have a total. When we look at the income statements for what we learned in financial accounting, that is merchandising or retail businesses, we saw that they did have to calculate their cost of goods sold, but it was based on an assumption about the flow of costs. And again, we reviewed this last class, LIFO, FIFO, average cost, because they had an invoice from their suppliers or multiple invoices from their suppliers showing how much they paid the suppliers for those products. And so then it was only a matter of maybe adding in the freight if they had paid freight on any of it, and also deciding based on that assumption about LIFO, FIFO, or average cost, which units did we sell. On the manufacturing side, we have to calculate that cost of goods sold based on a new calculation that we did not need to do in financial accounting, and that is the cost of goods manufactured. So one of the exercises we will do today, you actually will be preparing that separate new report called the cost of goods manufactured. As I told you last week, that report really is proprietary or confidential information. That's not information the company can't, well, they can, but it's not information the company would share with the general public. They're not required to. If they're publicly traded, they have to have an income statement, but they do not have to share the detail of that cost of goods manufactured. That can be confidential or proprietary. Okay. So I think before we get to the statement of cost of goods manufactured, let's go to our exercises. And we should be able to do our first exercise for today based on we should be able to do our first exercise for today, which is exercise 6, based on what we already know. I'm going to make this a little bigger. So I know most of you are probably way more, maybe all of you are way more tech savvy than I am, but I am going to tell you this, and if you already know this, good for you. If you're looking at this at your screen and the text is too small, you can enlarge that print by holding down the control key and spinning the wheel on your mouse. So you can make it bigger or smaller. So I generally do that because I want to make sure, one, people can see it in the classroom, but also because I sometimes need white space over here to be able to write on the screen. And so if the words are too big, I don't have enough room to do what I need to do to show you or talk you through what I'm trying to explain. The following events took place for Sorensen Manufacturing Company during January, the first month of its operations as a producer of digital video monitors. So what we're going to be doing is preparing the income statement, but also determining the inventory balances at the end of that first month. So what I'm going to write on the screen, it'll take me just a moment to do this. I'm going to put some T accounts on the screen. So this will be our first opportunity to use T accounts. I did talk about them a little bit last week when we went through the review materials in the reference materials folder. But I also will kind of talk you through that today as well. So we have three different inventory types of accounts, as we've already discussed and reviewed today. So I'm just going to label each of these. A T account is called a T account because it looks like a capital T. It has three parts. As you likely learned in financial accounting, it has three parts. The account title goes across the top of the T, which is what I'm doing right now. Putting the account titles on there. And then you have a left side and a right side. But because we are accountants and we like to have our own little language, we don't just call them left and right. We call them, as you should know, the debit. Yep, thank you. The debit and credit side. So I'm just labeling each one of these. So in accounting, debit means left and credit means right. There's nothing more to it. You cannot tell just by saying it's the debit side or the credit side on its own. You don't know whether that means to increase or decrease the account. You need to know which type of account it is. in order to know which side to use to increase or decrease that account. As I already showed you, in the reference materials, you have that expanded accounting equation that shows under each type of account, the T account and the debit and credit side are labeled just as I have done here. And then you see a plus and on one side and a minus on the other side. So if you can identify the type of account, even if you don't know this off the top of your head, you can look at that reference guide I have there for you and see which side has the plus, and that would be the side that is used to increase that account. And the side that has the minus in that reference material is the side that you would use to decrease the total dollars in that account. Each one of these accounts is an inventory account. So that is, of course, an asset, and assets are increased on the debit side, or in other words, they have a normal debit balance, and they're decreased on the credit side, or in other words, they have a normal credit balance. So all of that, I hope, sounds familiar to you, because that is very basic accounting knowledge that you should have brought into this class from financial accounting. If you really are unfamiliar with this, and again, this is an odd semester that none of you had me for financial accounting, and so I can't guarantee 100% that you did cover this in financial accounting. It just is something that certainly should have been covered. So if you do have questions on it, if you want to just kind of review that, I would encourage you to go back in our textbook. The ebook that you have in Cengage has the entire book starting with chapter 1. So it has the first 14 financial accounting chapters. What I would encourage you to do, if this sounds really unfamiliar, is go back and at least for the first 3 chapters of the book, start with the chapter summary. So each chapter at the end has a very nice summary. And so read that summary, and hopefully that will start to refresh your memory. And if you're still feeling unsure or confused, maybe read a little bit more of the chapter in depth, or ask me for help. Okay. So looking at our T account, so now I have all 3 T accounts set up, and we can start going through each one of these events that happened for this company. So, oops, why won't that slide? There it is. So this month, January, was their first month of operation. So what that tells us is they didn't have any opening balances. These are balance sheet accounts, and so let's get that up there. So these are balance sheet accounts. So after their first month of operations, it's very reasonable to assume that they would have balances that carried forward from the previous month, but brand new company, opening balances are 0. So we're really starting from scratch, starting from the beginning of this company's work process. So let's start here with letter A. First thing that happened, they purchased $250,000 worth of materials. So you should know, again, from financial accounting, that all transactions affect at least 2 accounts. We are only going to be showing on the screen the ones that affect these accounts, but I will talk about what the other side would be. So in other words, for every transaction, there has to be at least 1 debit and 1 credit. In total, the dollars debited and credited have to be the same. So if I put in a debit for these $250,000 worth of materials, we know there must be a credit someplace else. So looking at our exercise, and I apologize, I just paused the recording there for a moment. So looking at the exercise, we're starting with letter A. The first thing that happened is they purchased those $250,000 worth of materials. And as I said, we're only recording the part that affects these 3 inventory accounts because that's all we need for the exercise. But keep in mind, there must be, if I'm debiting materials, when we buy these materials and add them to the materials inventory, there must be a credit. So the credit here would be either to cash if they paid cash for them, or maybe to accounts payable or something that represents the liability to pay for them later. So debit to materials to increase the materials account, and then a credit to however they paid for them or agreed to pay for them. The next item then, letter B, says we used $180,000 of direct materials in production. So if you think back to that flow chart, that handwritten flow chart I was referring to last class, when we use materials in production, we physically take them out of the warehouse or wherever we store them, and we move them onto the production floor. And in our accounting records, we really do the same thing. We move it out of the materials inventory and we move it into work in process. And so we add debit 180,000 to the materials inventory, the work in process inventory, because we're adding it there. We're crediting the materials inventory because we no longer have it sitting in our warehouse. It's now out on the production floor. Letter C says we incurred $450,000 of direct labor wages. So as we saw in that flow chart, direct labor is added directly to work in process. What's the other side of this? Wages payable, payroll payable, something like that. We also incurred $180,000 worth of factory overhead. So I had explained on Thursday or our last class that factory overhead is accounted for in that separate cost pool or accumulation account, and then we allocate that. And so although this says incurred 180,000, I would like to change that to not incurred that expense, but we applied that expense. I would prefer that you didn't think of that as actual cost, but as cost that was applied out of that overhead account. So what's the other side of that? Well, that factory overhead, remember we talked last week about the types of expenses that would cost that would appear in there, including things like the wages for our indirect labor, the plant manager, the scheduling, the quality assurance, the maintenance and custodial services, the taxes, the depreciation on the equipment, and things like that. And so the credits of that 180,000 worth of factory overhead are to a whole bunch of different accounts: indirect labor, indirect materials, other miscellaneous types of expenses that we had to pay. I also will just point out that the fact that B and D have the same dollar amount is totally coincidence. And this will not be the last time you hear me say this. If I wrote the book, those would be different numbers, because I don't want you to get confused and think, oh, those two numbers are supposed to be the same. They have so many other numbers to choose from. I don't know why they had to choose exactly the same number for that factory overhead, but it's totally coincidental. So what you see now is that in the work in process account, we have now included or added all three costs that make up the product cost: direct materials, direct labor, and overhead. All three have been added into that work in process. As we started out saying, under normal circumstances, there also would have been a beginning balance in all three of these accounts in reality, but we don't have a beginning balance because it's a brand new company. Everybody good so far? Making sense so far? So letter E says we transferred $760,000 of work in process to finished goods. Well, what does that mean? Those are products, whatever it is we make, that we had finished. And so we're no longer in process, but we've actually completed them, and now they are available for sale to our customers. So in our factory, we probably move them out of the factory into the shipping department or out into our store if we sell right on site. And if in our accounting records, we accomplish that same thing by crediting work in process to remove it, it's no longer in process, and debiting finished goods to show it's now available for sale. As I told you last class, this finished goods inventory is really the closest we have to being analogous or being the same thing as the inventory account that we talked about in chapter 6, the inventory chapter, regardless of which book you used. If you had the Needles book, it's the same chapter. And so the finished goods inventory really is the same as the inventory account for a merchandising company. This is the product we have available to sale for sale to our customers. The next line, letter F, says we sold goods for $1.2 million. Well, that's how much we charged our customers. That's going to be the revenues. So when we get down to our income statement down here, that's going to be where we start. We made $1.2 million in revenue for the product that we sold. Now, those goods that we sold had a cost of $675,000. And so that $675,000 is moved out of finished goods. We just sold it. We don't have it anymore. We need to get it out of that inventory account. And where does it go? If you remember that flow chart, or if you look at that flow chart that's in Brightspace for you, and it now is the whole picture when you click on it, that chart shows you that when we sell the product, it moves off the balance sheet. Remember, these are inventoriable or product costs that were on the balance sheet until we sell it. And when we sell it, it moves on to the income statement as cost of goods sold. So the credit here is to finished goods. The debit would be to cost of goods sold. Now, the next two lines are what we call period expenses. If you think about those terms we introduced last class, the product cost is the direct materials, direct labor, and overhead. The period cost are those operating expenses, which include selling and administrative expense that you see here in H and I. So those do not impact these three accounts. So we have now put into our T accounts all of the information that was included in letters A through G. And we're going to hold off on H and I because they don't affect these accounts. So I told you last week that we would review anything that I expect you to know from financial accounting. And this is the next item, which is how to find the balance in a T account. So in a T account, the way you find the balance is you add up the debits and record that total at the bottom, and that's called the debit footing. So I'm going to look at the work in process inventory account. And I'm going to add up those three numbers on the debit side. 180, 450, and another 180 is 810 or 810,000. I didn't give myself quite enough room here. I'm going to be a little squished. But so that is called the debit footing. And you can write that down. I mean, it's easier maybe to write it down, or you can just do it, do it in your head and do it all in one step. The next step would be to add up all the credits, and that's the credit footing. And again, there's only one credit here, so not very complicated to add those up. Now that we have the footings, the final step is to find the balance, and we subtract the smaller number, the 760, from the larger number, 810. So the difference is 50,000. And that difference gets recorded on the side that had the larger footing or the larger total. Okay. So I know it's a little squished in there, but the balance in our work in process inventory at the end of the month would be $50,000. Is everyone okay with that? Okay. So go ahead and put in the I'm going to calculate the balances for the other two. So our materials inventory looks like the balance would be 70,000. And then for our finished goods inventory looks like it would be 85,000. So we don't have to put in footings when there's only one number on each side. So we now actually could go ahead and answer part B already. We have the inventory balances on January 31st. The materials, the work in process. And if you were able to get into C now, you're going to want to enter those in your part B. And then we can do the income statement. So the income statement that we have here is a multi-step income statement, similar to what you would have covered in chapter 5 in the Needles textbook. As with all income statements, we start with revenues and we end at the bottom with net income or net loss, depending. For a multi-step income statement, we subtract the cost of goods sold from those revenues to get what this book likes to call gross profit. I prefer the term gross margin. They mean the same thing, but we typically use gross profit when we're talking about just one specific product, not the company as a whole. So now that we've balanced all of the T accounts, we can enter those ending balances down here in part B, and we can go back to our income statement. And as I was saying, this is the multi-step income statement. So it's revenue minus cost of goods sold to get to our gross profit or gross margin. We were told in letter F that the amount we charged our customers was 1.2 million. And in letter G that the cost of goods sold was 675,000. Now I will tell you about this. See now, if it does not say whether to use negatives or not use negatives, it will accept either one. So some people like to say that, put the negative there in front of cost of goods sold because it reminds them to subtract. And I'm just telling you because I've been doing this for a long time, sometimes people forget to subtract and they add the cost of goods sold to the revenues, which would be a really cool trick for a business if spending more money made you more money, and that's not how it works. So if it helps you to remember to subtract, please feel free to put the negative in there, and the application See Now will allow you to do that. It will count it correct, whether you put the negative or not. There will be some exercises though that we get to eventually in the semester where it specifically says use a negative or don't use a negative. And that's the only time it's going to mark it wrong, if it says to use a negative and you don't. But for this, if I put the negative there or not, it will count either one of those as correct. Then we have those period expenses or our operating expenses, selling and administrative, that are given to us. And again, if you prefer to put in the negatives there, you can. And if you don't feel the need to do that, you don't have to. I should probably put in the negative. What just happened to my computer? Wow. Why did it do that? Why on earth did it just log me out in the middle of my? Okay. And so I'm putting in the negative just to be consistent, but again, you don't need to. Because the total operating expenses are less than the gross profit, we do know at this point that they will have a positive or a net income. Of course, if their total operating expenses exceeded their gross profit, they would have a net loss. And again, you can show that as a negative if it helps you or not. We have answered all of the questions for this exercise, so just because I like to do it, click the check my work button, and then I can check my score down at the bottom. As I've already pointed out, I'm not able to save my work, so I start over with my assignment score every time I come in here. But for you all, if you are working on it one day and come back to it the next day, it will have saved all of your earlier work and score. Okay, questions about that? So at this point, we should be a little bit more comfortable, getting a little bit more comfortable with the flow of costs through these inventory accounts, what each of the three is used for. Any questions? Here are my drawings. And let's move on to the next exercise. We're going to do the first column together, and then I'm going to pause the recording and ask people who are here physically in the classroom to try the second and third columns independently, and then we can answer any questions you might have. So this relationship that you see here, finished goods inventory plus cost of goods manufactured equals cost of goods available for sale, less the ending inventory equals cost of goods sold. That relationship looks very similar to what we learned in chapter 5 in financial accounting, except now we're using this word finished goods rather than just calling it inventory. Because again, for a manufacturing company, they have 3 different types of inventory, where a merchandising company has but one. I also want to point out to you in the reference materials folder in Brightspace, I can get there. So the reference materials folder for this chapter, open that up, has some basic calculations for a manufacturing firm. And what we just went over is right here. So you may find these formulas, these calculations, useful as a reference. We'll be using them ourselves in these next couple exercises. So what we're doing here, you also have access to. And so I said we'd do letter A and B, the first column, together. So we start with finished goods inventory. So that's how much they had at the beginning of the month, $116,600 worth of finished goods available for sale to their customers. During the month, they continued to make additional merchandise, and they added to that finished goods inventory $825,900 worth of inventory. So they had available, probably not all at the same time, but throughout the month, they had a total of $942,500 worth of stuff available for sale. At the end of the month, they had only $130,000 worth of merchandise still in ending inventory. So what happened to what's missing? We must have sold it. So the amount we sold is what is missing from what we had available minus what we had at the end of the month. So $812,500. Everybody good with those? Okay, so I'm going to pause the recording, as I said, and ask you to try columns 2 and 3 on your own, and then I'll restart the recording. So if you are watching on the recording, please pause your recording, try second and third columns on your own, and then restart. So let's just look at those last 2 columns. So for letter C, if we had $540,000 worth of stuff available throughout the month, and we started with $38,880, we must have produced $501,120 during the month. So I just subtracted. I'm showing all the calculations here. For the second part of that, we had $540,000 available, and we ended with $70,000. We must have sold $470,000. And then for the final column, if we had 1,100 available and only 180 was made during the month, we must have started the month with 920,000 for letter E. And for letter F, if we had 1,100,000 available and we sold 945, then we must have ended the month with 155,000. So this is not necessarily the flow that would happen. You know, these are not the normal calculations. What we did in the first column is really what information we would have available. How much we started with and how much we made. to get to letter A, and then how much we had left to determine how much we must have sold. We always should be backing into that cost of goods sold number, because we have the issue with inventory called, put it on the screen, inventory shrinkage. So that's probably something you heard in chapter 6, that sometimes we don't actually sell the inventory, but we also no longer have it. And there's many reasons that could happen. Could have been given away as promotional material. It could have spoiled if it's something that has a shelf life on it. It could be that it was stolen or miscounted or something like that. And so the rule we follow in accounting is, if we had it, if it was in that available for sale number and we no longer have it at the end of the month, we count it as part of cost of goods sold, because it is part of the cost of doing business. And so the way we did this in the first column to back into cost of goods sold is the way it would be done in reality as well, because there will be, in most cases, some inventory that is not accounted for at the end of the month. And we call that inventory shrinkage. So just because I like to have my green check marks in there, I'm going to click the check my work button. Remember, when you do use that button, if you're working on this outside of class, it usually gives you some pointers. It doesn't necessarily lead you to the answer, but it should be helpful if you do have questions on something you're working on outside of class, including the problems. And I want to go back now to the PowerPoint so we can talk about what comes next, which is that cost of goods manufactured. Any questions though about where we are before we move on? So the statement of cost of goods manufactured has come up a couple of times already, and you know that this is something that a manufacturing company needs to prepare, because they need to know the bottom line. They need to know the dollar amount of the cost of goods manufactured, but this is not something that would be included in their annual report. It is not a financial statement. It is information that's needed to prepare those financial statements. And I told you last class that this format that we see here for the cost of goods manufactured is what we are going to follow. And this is posted in the chapter folder as well. So if you look at the reference materials in Brightspace, you will see a snip of this so that you can kind of follow along with that format when you're working on maybe the homework problem for this chapter, or maybe on the exam. So really what we are doing on the statement of the cost of goods manufactured is analyzing all of the flow of costs in and out of the work in process inventory account. So if you go to that hand-drawn picture that I keep bringing up, that hand-drawn picture shows all of the arrows going into and out of the work in process inventory account. And that is exactly what we're accounting for here, all of the dollars that go through that account. What did we have at the beginning? What did we add to it? So this little part, I can show you. So this part right here is analyzing the flows in and out of the materials inventory. Okay. So we figure out how much did we use from direct materials. We then add in direct labor. So that's the other flow coming in from payroll on that diagram. We add in overhead, which is allocated out of that overhead cost pool, the circle up on the top right on that diagram. Then we know how much we added in total to that account. We add that to the beginning balance so that we know everything that was in that account at any point during the month. We subtract what was left, the ending work in process, and that's how we get the cost of goods manufactured. That number then is used for calculating cost of goods sold, which does appear on the income statement. So what we're going to be doing now in our next exercise, in exercise 8, is preparing a statement of the cost of goods manufactured. So again, we're going to be following this format and preparing our own. You may find it helpful then, you may not, to pull up the, whoops, I clicked on the wrong one. So you may find it helpful, you may not. So what we're talking about is all of these arrows coming into and going out of this work in process account. So in exercise 8, we have cost data for Johnstone Manufacturing Company for the month ended March 31st. So you can see for the 3 inventory accounts, we have both the beginning and the ending balances. We're then given additional information about direct labor, about materials that were purchased during the month, about overhead that was incurred. And again, I'm encouraging you to not think of that as incurred, but allocated. It will make it easier for you to make that switch when we start talking about that on Thursday in chapter 16. So factory overhead incurred is added to that cost pool for factory overhead, and then we allocate it. So it's not a direct, those are indirect costs. So thinking about that format that we just saw, recognizing that this entire statement is about what happened in the work in process inventory account, we know our starting point is what was in there at the beginning of the month. So here's our work in process at the beginning of the month, 435,900. Then we want to know, well, what did we add to that? So we started with 435,900. What did we add to it? We know we added direct materials, which is going to take some work to determine. We also added direct labor, and we added some overhead, and they're going to have us list each one of those overhead accounts or overhead, expenses, costs separately. But let's look at our direct materials next. So to calculate the direct materials, again, we start with, well, what did we have at the beginning of the month? And that's right here. We had $210,000 worth of materials at the beginning of the month. But we were told that we actually bought a whole bunch more. So right here is how much we purchased and added to that materials inventory during the course of the month. Probably not all at once. All of these materials were not all in there at the same time, but it's $2,666,200 that we purchased during the month. And so if we add those two together, it will tell us how much material we had available to use. And then if we subtract from that how much we had left at the end of the month under the same concept that I just talked about with cost of goods sold, if we had it and we no longer have it, we assume it was used. So we back into how much did we use by subtracting how much we had left from how much we had available. So we had left 193,1. And just like I told you in the previous exercise, if it helps you to remember to subtract that materials inventory, you absolutely can put a negative there. The only time you can't do that is if the exercise specifically says use a negative or don't use a negative. Otherwise, it will accept either the negative or the positive. And so we started the month with $435,900 worth of work in process. That would have included some direct materials, some direct labor, and some overhead. We've now added to that more direct materials, about $2.7 million. We add direct labor, that's $3,500,000. And then we add the overhead. So unfortunately, we have to put each one of these in separately. indirect labor, depreciation. So this is a good reminder for us of the types of costs that are indirect costs or factory overhead. This heat, light, and power would be the heat, light, and power just on the factory. It would not include any heat, light, and power or utilities for the office building or for the store, if we have a store space. These costs that we are entering here are only the costs associated with running the factory, running the manufacturing facility. And then if we add all of those together, we will have our total factory overhead that was allocated to work in process during the month. So again, we know what we started with. We now know what we've added to it. So if we add the beginning balance plus the three elements that we added to it, direct materials, direct labor, and overhead, we will have the total manufacturing costs during March, $6,998,700. Sorry, that number, I apologize. That number is what was added during March. It said that, but that's not what I started with. Now the total manufacturing costs, including the beginning balance. I think I had said to add the beginning balance in there. Our total manufacturing costs, what we started with, the 435.9, what we added to it, direct materials, direct labor, and overhead. We had 7,434,600 that were in process at some point during the month of March. If we subtract from that our ending inventory, which is given all the way up at the top, 510,400. So we ended the month with more than we started with. We started with only about 435. We ended with 510,000. And so you'll notice that our cost of manufacturing is a bit less than so we incurred almost $7 million in costs during March, direct materials, direct labor, and overhead, but we didn't finish all of that. Our finished, the product we finished and moved out of work in process into finished goods was about $6,924,200. Any questions on that so far? The last question we have then for this exercise is, what was the cost of goods sold for March? So I'm going to go back to those calculations. And we have right here how to find the cost of goods sold. So just for our purposes here, I'm bringing this formula over. So with that formula, we can now find the cost of goods sold. We know the beginning finished goods inventory. It's given right there, 586,200. We just calculated the cost of goods manufactured down here, 6,924,200. 6,924,200. Whoops, not that number. So if we add those two together, we get the total cost of goods available for sale. We started with 586,200. We finished another 6,924,200. And so our total, squeeze this in here, our total cost of goods available for sale, what we started with and what we added to it, about 7.5 million. And then our final step is to say, okay, we had that much available for sale. how much did we not sell? How much did we have left at the end of the month? And that would be the 615,900. If we subtract that, we get our cost of goods sold. $6,894,400. And so hopefully having those formulas written out for you in the reference materials folder in Brightspace will help you when you're asked this kind of a question. So even when we don't have the format, sometimes the format's right in the exercises, and sometimes, as you've just seen, we need to do a little bit of work outside of that. Questions on where we are right now? All right, we'll keep going then. We're making good progress. So in exercise 9, we're looking at calculating cost of goods sold. Again, it's going to be the same format, the same formula that we just used in our last exercise. So I might even be able to paste that right in here. We'll see. Yep. So to find cost of goods sold, I'm just going to paste this in here to remind us, to remind you of the formula. So this cost of goods sold calculation looks very similar to what we used for a merchandising or a retail company in financial accounting. What's different? Rather than having cost of goods manufactured, we have cost of purchases. And rather than referring to finished goods inventory, we simply refer to inventory because merchandising companies have just one. So our format here is really going to follow this same basic manufacturing calculation that I have in the reference materials. What did we start with? What did we add to it? And we just saw in the last exercise how we calculate that cost of goods manufactured. That tells us how much we had available for sale. What did we have left at the end of the month? Subtract that to find our cost of goods sold. This calculation for cost of goods sold is part of the income statement. So I already said the cost of goods manufactured is really confidential or proprietary information, where the cost of goods sold is not. So cost of goods sold, that line item is going to appear on the company's financial statements, on their income statement. If you don't see it, it's almost certain that you're looking at a service company because they don't sell goods. So they don't have a cost of goods sold. Even some service companies have a category broken out on their income statement that's called cost of services or cost of services provided. So now it's just a matter of pulling in that information from what's given up above. And I will stop talking for a moment and let you do that if you have not already while I was reviewing. And again, when you need to subtract, you can put in the negative, and I would encourage you to do that if it helps you remember. And so I found, if I used my calculator correctly, I found cost of goods sold of $4,595,000. Everyone okay with that? Not the same thing? Part B is to find their gross profit, or as I suggested, gross margin. The gross margin is definitely more commonly used throughout this textbook. They do use the term gross profit, but in the real world, I'm just going to suggest that you'll see gross margin much more frequently. Gross profit is typically only used when we're talking about a specific segment or portion of the company, not when we're talking about the company as a whole. Whoops, I put an extra 0 in there. And so their sales are given as $6.6 million, and we've just calculated their cost of goods sold. I'm going to use the negative to remind us to subtract. And so they have just over $2 million in gross margin or gross profit. And then once we have that gross margin or gross profit, I'm just going to bring that number down. We can finish up the bottom part of their income statement by including their operating expenses, those period expenses, selling, general, and administrative expenses, and those are given up here as well. Oops. And because their total operating expenses are less than their gross margin, they do have a positive income. In this case, $1,135,000. Questions, anybody? Really like to see my green check marks. Occasionally I do have a math error, like I hit a button wrong on my calculator and nobody says anything when you get something different. Please feel free to speak up if a number that I say doesn't match a number that you have on your paper, because I am just as likely to hit a number wrong on my calculator, even though I try to be careful. And we're going to move on. So this is our final exercise for this chapter. Now we do have a good amount of time left in class, so we're going to finish this exercise, and then I'm actually going to stop this recording and then start a new recording, and we're going to talk about the beginning of chapter 16, especially because I will be gone. I would like to get through as much of chapter 16 as we can while I'm here and leave as little as possible for you to cover on your own next week, along with the beginning of chapter 17. So looking at this exercise, you can see that we're being asked to calculate the same concepts that we've been looking at over the last few exercises we've done today. So I'm going to ask you to do these on your own. I'm going to pause the recording and I will put mine on the screen. I'll restart the recording and quickly talk you through to make sure that everybody got it. So if you're working on this on your own, watching the video, please pause your recording, finish this exercise, and then restart. Okay, so now that you have done those calculations, I did mine a little bit out of order. I don't know if you needed to, but for me, it made more sense to do it in a little bit different order based on the way things would really happen. And so direct materials is what I did first. This is the first month of operations for this company, so the beginning balances were 0. I included that just to remind you that there would normally be a beginning balance. Added to that the materials that we purchased, so I knew how much we had available. And then we were told the ending inventory was 33,000, so we must have used or transferred into work in process 211,200. Direct labor was a little bit more challenging to complete. So we had the total manufacturing cost for the period. Now we would not normally know that if we didn't know the direct labor. So this was kind of looking at things in reverse order. We knew the total of that total manufacturing costs. We knew how much was direct materials. And of the other information that was given, I could identify two, indirect labor and depreciation, that were overhead. So I simply subtracted those to determine direct labor of 46,200. Then I turned to our work in process ending inventory. So the beginning inventory again was 0. We had added total manufacturing costs, including direct materials, direct labor, and overhead of 455,400. So that's how much we were working on during the month. And then we were told that 396,000 of that was completed and moved into finished goods. And so that would have left 59,400 in ending inventory. Next up, what I did, cost of goods sold. We could have done this from the beginning. The sales were given and gross profit was given. So cost of goods sold would be the difference between those two numbers. And then finally, I could find our ending inventory of finished goods. The beginning inventory again was 0 as a brand new company. They had manufactured or completed work on 396,000. And then they had sold 330,000 of that, we knew from here. And so the finished goods ending inventory must have been 66,000. Get my green check marks in there. Does anyone have any questions about any of those? Okay, so this is the end of chapter 15, and I'm going to stop this recording. We will start a new recording and start talking, spend the next few minutes here talking about the beginning of chapter 16.